Thanks for tuning in to this episode of The Resilient Advisor. My name is Jay Coulter, and on this episode, we're going to do our monthly installment of the Risk On, Risk Off report with Michael Guyad, portfolio manager at Toroso Investments and publisher of the Lead Lag report.
Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Michael, I always love producing this monthly show because you have such great context for what advisors should be looking at from a risk-on, risk-off perspective that they can implement in their portfolios after the episode. So let's get right to it. Let's talk about the housing bubble or potential housing bubble in the marketplace today. What's your take?
So look, I've been kind of teasing this idea that there are some similarities to the housing bubble and the peak in terms of 2005 and 2006. Obviously, there are a lot of things that are different. We know that the pandemic has driven prices through the roof. Available supply is relatively low. Demand, especially from millennials, is quite high. But you have this dynamic now, and it's beyond just anecdotes, where when you look at incomes relative to median home prices, you're reaching bubble-type territories. In other words, the affordability of housing now has gotten really outside the realm of most people's cash flow. And the fact that you don't have the same dynamics in terms of the sort of CDOs and all these kind of exotic debt instruments in 0506, even though you don't have that, the overpricing that's going on in the housing market, I think, can have negative implications because housing is such a bright spot for the economy and for credit creation. Now, I've made this point before that up until this lumber crash, off the highs, lumber's down about 50%. But prior to the crash, the ratio of lumber to gold was at levels not seen since 2005, 2006. So from an intermarket standpoint, I think we got very much out of whack on the housing situation. Lumber crashing is a portion, partially driven by sawmills coming back online, but also I think partially driven by a realization that construction is going to slow down and some of this activity that we've been seeing that's been so hot is going to start to cool off. So I going back to the original question, I don't know if you can argue necessarily it's exactly a bubble. There are some parallels, I think, in terms of the mania going on in terms of price movement. But, as is always the case, the cure to price is high price. And I think given the way that housing has behaved and how far out of whack it is now relative to incomes, that probably is going to be more of a headwind than a tailwind.
Yeah, so I really struggle with this because I live in the suburbs of Atlanta. Houses, sometimes they don't even make it on the market. When they do, they're just there for a couple of days. And my wife and I actually, we took a drive around and looked at the houses that were on the market. There's nothing special about them, and they're going for 50% what they would have been valued even 2 years ago. And I just don't see the incomes being produced in the suburbs of Atlanta to justify these prices. Is this really just a function of interest rates being so low for so long? And if that continues for another couple of years, could we see the prices of these houses continue to rise?
Well, I think the answer to that depends largely on what the Fed does. So what doesn't seem, and others have noted this point too, that the Fed, is still supporting mortgages. I mean, they're doing a lot of MBS mortgage buying, bond buying, right? And which makes no sense. They're basically supporting a very hot housing market, making it hotter, right? Mm-hmm. And to your point, it's not just you. I mean, I'm actually in Maine now, which is why my internet connection is a little bit off here. But the housing prices that are going on here for very small pieces of land, very small properties are just utterly insane. You can't even justify it. I mean, even if you have a super long-term outlook. So I do think there's a degree of mania that's happened. I do think obviously these low mortgage rates have been a source for that. And I also think just in general, look, the Federal Reserve has made it very clear that they are going to keep pushing assets further and further. Most people view the housing and real estate as the ultimate asset, much more so than stocks. So I think that's also just sort of at the margin, sort of causing this paranoia to buy real assets because we're going to have significant inflation if the Fed gets its way.
So what about the implications for the commercial space? What are you seeing? What are the prices in that space telling you today? And how should financial advisors consider that when they're looking at their portfolios?
Well, so look, the taking a step back, part of that discussion is a discussion around REITs in general, right, as a sector of the stock market. And we all know the story, right? COVID caused a lot of people to move out of, corporate properties, out of their offices, and working from home remotely. So you had this sort of shift away from steel city buildings to lumber, suburban homes. I suspect that we're going to start to rebalance a little bit on that side of things. And you can see that when you look at REITs as a sector of the stock market. I've been noticing this in the lead lag report. They have been one of the last to really move on the recovery, which makes sense because a lot of REITs have that sort of corporate property aspect to it. So the fact that REITs now are starting to show some momentum would suggest that market participants are starting to think that yes, commercial properties probably make a bit of a comeback. Yes, some of these rentals start getting filled up because the skew of home prices to rentals is also incredibly out of whack. But that's not going to go back to the way it was pre-COVID, right? This is sort of more a trying to identify where the new mean is, right? Where the new average is in terms of that relationship of the corporate real estate market.
All right, next topic is inflation. I can't have anybody on this year and not talk about inflation. In fact, I co-host a show with the folks over at Capital Wealth Planning, the Kevin Simpson Show. And we recently had Bert White, the CIO of LPL, on the show. And I asked him about inflation, and I thought his initial response was interesting. I want to play it for you.
Look, it's impossible to get away from the I word. If you go to Google Trends, I love to go to Google Trends, put in the word inflation. That goes back to 2004. Never, ever has actually folks searched the word inflation more since 2004 than they are today.
I mean, it's incredible, right? And the perception of inflation can create problems as well. What's your take on inflation as we sit here recording this in the middle of 2021?
Well, it's probably higher than most people think, right? Certainly more than the Fed thinks. So keep in mind when we talk about inflation, deflation, there's a lot of nuance to that. One is it's personal to every single person, right? Inflation in New York is very different than inflation in Nebraska in terms of one's own personal spending power and how taxes and other things and cost of goods around impact that. The other part of this is there's inflation that you see real time, and there's inflation that you don't see because there's no mark-to-market price, right? So the mark-to-market price that historically has actually been the most important is your shelter, right? So, and we've seen that housing prices. This is what's kind of amazing about the housing situation. It's like a lot of people are saying, "Oh, I'm making so much money. My home value is going up." Okay, great. Well, if you sell it, you got to live somewhere else. Unless you live in a completely different state and city, you're just going to be, downgrading to a smaller property for more money, right? So you've got, I think sort of this affordability inflation issue is a pretty big one. And yes, a lot of people are looking at the term. However, I do think that that's probably more a short-term phenomenon. The fact that so many people seem to be searching the term inflation on Google may actually be more of a contrarian signal. And that's consistent with the behavior of treasuries on the long end. The fact that yields keep on wanting to fall 10-year, I think, is now below 150. Despite all this narrative around reflation, would suggest actually that this is probably a little bit extreme in terms of this inflationary narrative that's out there. And, look, we are in the business. I can't tell you how many people on Twitter through my account at Lead Lag Report, when I say, lumber is down 50%, be very careful. I can't tell you how many people say, what the hell are you talking about? Lumber's still at all-time highs. Because they are still seeing the prices at Home Depot. They're not seeing futures prices, right? They're still seeing the inflation, that's from delayed reaction of COVID and supply chain disruptions. They're not seeing what the market itself is anticipating with these commodity prices across the board falling. So, to me, that's more of a contrarian signal that we may be entering more of a disinflation, deflationary period. And by the way, that's completely consistent with all the other intermarket things that I track. Again, yield curve looks like it's flattening, inflation expectations starting to break. Lumber to gold weak, suggestive of risk off, which is a deflationary type of environment. Utilities looking like they're going to start to outperform the broader S&P, also risk off, also disinflation. So you always want to bet where the crowd is convinced money is going to go. If the crowd is convinced on inflation, I think it's actually time to start thinking the other way.
Wow. I tell you, so I struggle with this, and I know financial advisors struggle with this because their clients are calling in. They're obviously they're a part of that group that's doing the Google searches. But I go out to dinner, foods cost 50% more than it did before the pandemic. I live in Atlanta, Georgia. It's hot. Now, power bill through the roof. If I wanted to upgrade my house, not rational prices, because I would never get my money back trying to sell it someday, I would think. So things that I actually need are going up in price dramatically. Everything else is really just portfolio manager and economist speak, right? Because people paying money for used cars and everything I just mentioned, that's real world pain. How should a financial advisor describe inflation to their clients as they're building their portfolios?
I think for most advisors, the communication should be around not just inflation, of course, but how do you manage that inflation? Meaning, okay, so that steak is a lot more expensive than it used to be. Maybe you simply have to get a smaller steak, or maybe you have to think about some other protein, right? Sort of the substitutes argument when it comes to inflation. Look, I get the sentiment and where everybody's feeling it, and the inflationary pressure is unequivocally there. And the question is, is it transitory, as the Fed seems to think it is? Right now, the market seems to suggest it is. So what I would say to advisors is tell the end client, listen, it's been painful, but with one extreme tends to come the other. And if prices have, in terms of the acceleration, gone up so much, that's not to say that prices will necessarily go down very aggressively, but the pace at which these inflationary pressures have been rising probably starts to subside. And that may be all that end clients need to just be a little bit more comfortable. You have to really have a longer term view on this. I tend to be much more deflationist in my longer term thinking, and the bond market seems to be agreeing with me. Despite all of this money and stimulus, keep in mind, yes, you're having inflation in things we need, but not necessarily in stocks, right? So the S&P is near all-time highs, but small caps, despite all these trillions of dollars of stimulus, which is supposed to be inflationary, haven't pushed small caps higher. The last 5 months, they've gone nowhere. Same thing with emerging markets. So my point is that the market itself is starting to actually say that this stimulus may end up having a sort of a negative impact on the economy, and these prices will at some point break.
If this is your first time tuning in to this risk on, risk off report with Michael, you have been incredibly consistent with that view. Longer term deflationary, potential for some inflationary shocks here in the short term. That's been your stance, it seems like, for about a year. Is that fair?
Yeah, I mean, I would say almost since my entire career, because again, every single round of disinflationary pressure, which is what risk off is, just another way of saying risk off is deflationary pressures, results in lower and lower rates, more and more QE, more and more stimulus, more and more dollars thrown for less and less impact. Mm-hmm. That creates short-term inflationary pressure, but you just increase the debt bubble, and that ends up being longer-term deflationary. So I don't think it's inconsistent to say that the answer to whether it's inflation or deflation is yes, it's both.
Awesome. Let's pivot to Bitcoin. I don't think we've recorded an episode in the last 6 months where we did not talk about Bitcoin. But what's interesting today is the technicals. It's fallen below its 250-day moving average. How should advisors look at Bitcoin today?
Well, I think, as we know, a lot of advisors want to get in the space, but they're not quite clear on how to do so. And their clients are obviously asking about it quite a bit. I'm sure they were asking more about it when it was at all-time highs than where it is today, effectively having gone nearly round trip, losing almost all the gains for the year. It's not clear. It's not the only real technical rule I've seen that works with Bitcoin and cryptocurrencies so far, in terms of how it's additive to a portfolio, is rebalancing. Meaning, if you put a 1, 2, 3% allocation, and every single month you're simply harvesting the volatility by selling back to the 3% when it's gaining and upping it back to 3% when it's falling, that tends to add much more alpha than sort of a buy and hold type approach. I am not of the opinion that the sell-off in cryptocurrency is over yet. I could be completely wrong, and it's not because of anything except that I think we're still headed for a risk-off period where anything that's margined and leveraged gets hit. We know cryptocurrencies are incredibly levered. You can see that based on the type of leverage that's being offered overseas, right? 50x, 100x Bitcoin. We know also that U.S. stocks are very levered. not to the same extent, obviously. But if you get a risk-off period, which is a deflation pulse, the last thing you want is an investment that's highly levered. I think cryptocurrencies, Bitcoin in particular, and they all kind of still fall under that umbrella.
Excellent. If you are not subscribed to the Lead Lag Report, I highly recommend it for great insights on where there's risks on or risks off in the market. Visit leadlagreport.com. That is leadlagreport.com. Are you struggling to hold your team accountable? Do you struggle getting them to see your vision and drive results? The Resilient OKR system for financial advisors could be your solution. OKR is an acronym for Objectives, which are your big inspirational goals, and Key Results, which are how you and your team are held accountable. This is the Silicon Valley method that drives growth at major companies such as Intel, Google, BMW, and Disney. Move your business results away from opinions and measure it with data.
Pick up your complimentary access to the Resilient OKR system for financial advisors by visiting resilientadvisor.com/OKR.